Welcome to our business education and research. Today we will dive into value investing, a time-tested approach to stock market investing that focuses on identifying undervalued stocks with strong potential for growth. In this video, we will discuss the best strategies that successful value investors use to identify opportunities and build wealth over time. Whether you are new to investing or looking to refine your strategy, this guide will provide actionable insights to help you succeed. Let us start it. Value investing is a strategy where investors seek out stocks that are undervalued compared to their intrinsic value, often identified through financial analysis. The goal is to buy these undervalued stocks at a discount with the expectations that their market price will eventually reflect their true worth, leading to significant returns. For example, Warren Buffett, one of the most successful value investors, purchased Coca-Cola shares in 1988 when they were undervalued, resulting in massive gains over the following decades. The margin of safety is a principle that emphasizes investing in stocks at prices significantly below their intrinsic value to minimize risk. By ensuring a margin of safety, investors protect themselves from errors in judgment or unexpected market downturns, providing a cushion against potential losses. For example, if a stock's intrinsic value is estimated at 200 but is currently trading 150, the 50 difference represents the margin of safety, offering a buffer against market volatility. Fundamental analysis involves evaluating a company's financial statements, management, and market position to determine its intrinsic value. Key metrics include price-to-earning ratio, debt-equity ratio, and return on equity ratio, which helps investors assess whether a stock is undervalued or not. For example, an investor analyzing Infosys might look at its PE ratio compared to industry peers to determine if it is undervalued, while also considering its debt levels and profitability. Value investing requires a long-term perspective as it may take years for an undervalued stock to reach its intrinsic value. Holding investments over a long period allows for the compounding of returns and gives the market time to correct the undervaluation. An investor who bought HDFC Bank shares in the early 2000s and held them to a decade would have been substantial growth as the company's value was realized by the market. Focus on quality. Criterion. Value investors prioritize quality, looking for companies with strong balance sheets, competitive advantages, and reliable earnings, even if the stock is not the cheapest. Rational. Investing in high quality companies reduces risk and increases the likelihood of sustained returns as these companies are more resilient during economic downturns. For example, Nestle India, known for its strong brand and consistent earnings, is often a target for value investors despite its premium valuation due to its quality and stability. Patience and discipline. Virtue. Successful value investing requires patience as it may take time for the market to recognize the true value of an undervalued stock. Practice. Discipline in sticking to value investing principles despite market fluctuations is crucial for long-term success and avoiding impulsive decisions. For example, investors who remained patient with Maruti Suzuki during periods of market turbulence ultimately benefited from the stock's long-term appreciation as the company continued to grow. Diversification. Importance. Diversification involves spreading investments across various sectors and companies to reduce risk and enhance the potential for returns. Strategy. While value investors may focus on undervalued stocks, they also ensure that portfolio is diversified to protect against sector-specific downturns. For example, a diversified portfolio might include undervalued stocks in sectors such as technology, healthcare, and finance, providing a balance of risk and potential returns. Avoiding value traps. A value trap is a stock that appears undervalued but remains cheap due to underlying problems such as poor management or declining industry conditions. Prevention. Investors can avoid value traps by thoroughly researching the company's fundamentals and understanding the reasons behind its low valuation. For example, a stock like Kingfisher Airlines, which was once considered undervalued, turned out to be a value trap due to company's ongoing financial struggles and management issues. Reinvesting dividends strategy. Reinvesting dividends allows investors to purchase more shares of undervalued stocks, compounding the returns over time. Benefit. The strategy accelerates wealth accumulations as dividends are used to buy additional shares, increasing the investor's stake in a profitable company. For example, an investor who reinvested dividends from ITC Limited over several years would have increased their holdings significantly, benefiting from both stock appreciation and compounded dividends. Thank you for watching our guide on the best strategies of value investing. By focusing on these strategies such as understanding intrinsic value, remaining a long-term perspective, and avoiding value traps, you can build a strong foundation for successful investing. Remember, value investing requires patience, discipline, and a commitment to ongoing learning. Stay tuned for more insights and tips on investing and financial success. Don't forget to like, share, and subscribe to our channel for more valuable content.